we generated a 51% growth of profits in 2010 compared to 2009. And that we're really pleased about, as I'm sure have our shareholders been as well. And some of the key drivers that helped us to generate this is growth in revenue, top line, as well as very, very good control on costs. That has been offset by increase in impairments that we've seen by about £5 million equivalent, which is about 600-700 million shillings. And whilst that number in absolute terms may look high, but in the context of the balance sheet that we manage, it's about 1.2–1.3%, which is a manageable level, and for the balance sheet of our size is way, way below acceptable level. So I think revenue growth is very important contributor to that, as well as management of costs to get us to that. We also have had, of course, one-off income coming out of disposal of our custody business in the course of the year. But even excluding that, we were able to register 20% underlying profit growth for the year.
Now, looking at your operating expenses, they were fairly consistent, growing by only 1%. Is this sustainable moving forward?
Well, we will not have a choice but to make it sustainable. You see, when you build a business, you will build a cost base, but you expect to see that cost and investment come through the revenue growth. And I think the market is ready for growth. We've seen good things happening in this market. GDP growth has started picking up, and we are prepared to take advantage of that growth. However, should anything change, and we are entering the election period, we are seeing interest level continue to be moving down, and businesses and corporates might actually take a bit of a wait-and-see attitude, and that may have an impact on the size of the lending book that you can actually build in the next 12 to 18 months. And so when those kind of things happen, you have to look at your cost to make sure that you don't continue to run an expensive machine that is not generating money.
Speaking of interest rates, we've seen them edging slightly upwards towards the end of 2010. Where do you see them moving into 2011?
I think in interest rates, the biggest signal that we have is, of course, the government borrowing that we see in the market. That is going to be the single biggest driver. Of course, there's the Monetary Policy Committee that looks at various factors like inflation and other things to see what the central bank rate is going to be. Now, as you see government borrowing pick up and the private sector wanting to borrow for their own business growth, then the demand for liquidity, will definitely force up the interest rates. Now, we haven't seen that intense level of competition at the moment. And so the answer to the response to your question for me would be, it would be driven to a large extent, but by what we see in the fiscal policy guidelines from the government side. We have already seen it edge up slightly, but what I cannot overemphasize is the fact that a stable interest rate environment is good for business, is good for financial institutions, and is good for customers. And when you have businesses that are able to see a predictable level of financing costs that would enable them to take longer to medium-term decisions, then that makes everybody happy. It grows our businesses, it grows our country, and customers will be happy. And I think that would have a multiplier effect that you can't see anywhere else.
Finally, Mr. Mohammed, what areas will you be focusing in 2011, and what are your key projections for this financial period?
The results that we announced today is an outcome of some of the investment decisions that we made a few years ago. We have seen low interest rates environment approaching way back, and because we believed it is not sustainable to see spreads of 13 to 15%. That we saw, in the early 2000s. And so to do that, you have to basically manage, first of all, your cost of funds as a way of coping with low lending rates. And we did that by actually increasing the infrastructure in terms of the distribution network so that we could mobilize lower cost deposits in different parts of the country, especially in the rural areas. So we doubled our branches from 60 to 120 in the period of 2007-2008. We then made investments in technology because that will drive, efficiencies and cost of doing business much lower than we've seen before. Now, we launched a new state-of-the-art banking platform mid last year, which would drive efficiencies for us in the coming years. And so we are not in any way changing our strategy, moving in a different direction. We have made investment decisions both in terms of infrastructure distribution network, around people, around technology, and what is left is now execution. And I think the winners in the financial services sector of the future would not be very much about who drives the best strategy. It's those who would actually execute flawlessly, in a much lower cost and quicker than anyone else.